Let me start with a simple question. When you make your insurance payment every month, what do you think you're doing? If you're like most people, you probably think that you are setting a little something aside, building a balance, just in case. You may not say it that way, but that's kind of how it feels, right? You pay faithfully month after month, year after year, and somewhere deep down inside, you think, if something ever happens, at least I'm covered. But here's the problem with that belief, and it's what I want to unpack today. Insurance is not a bank. It's not money sitting in a vault waiting to be withdrawn when you need it. It's not a savings account. It's not a deposit. Every single premium payment is a wager that something might go wrong, and the insurance company is betting that it won't. And because they're the ones who write the contract, set the terms, and adjudicate the rules, guess who wins most of the time? So in this episode, I want to pull back the curtain on that illusion. We're going to look at why people feel betrayed when they finally file a claim, why insurers seem to change personalities the moment the accident happens, and what you can actually do to protect yourself before you're ever in that position. Let's talk about the illusion of banking on insurance. We're going to break down why people so naturally fall into this insurance is like a bank mindset. It starts with how we're wired to think about money. When we pay someone regularly, a mortgage, a car payment, even a utility bill, we associate that payment with a specific outcome. If I pay my mortgage, I get to keep my house. If I pay my power bill, the lights stay on. So when we pay insurance premiums, our brains do kind of the same thing. I'm paying for protection. It feels like ownership. But the truth is, you don't own anything tangible when you pay that bill. You're paying for a promise, a contractual agreement that says, if something happens, we'll consider paying for it so long as it matches the conditions that we wrote. That is a very different thing than depositing money. Here's what a bank does. A bank holds your money. A bank gives you access to that money whenever you ask for it. A bank charges a clear fee for a specific service, like a loan or an overdraft fee. Now, here's what an insurance company does. Insurers collect everyone's money into one pool. They use complex algorithms to predict how many of you are going to make claims. Then they invest that pooled money to earn profits. And they pay their claims only if they meet the strict internal guidelines. So right from the start, the foundation of that relationship is completely different. One is custodial, that's the bank. It holds your money for you. And the other is completely adversarial. An insurer manages their money against your potential loss. Here's a practical illustration for you to consider. Imagine that you have two neighbors. Both pay about $200 a month, one into a savings account and the other into an insurance policy. 5 years later, that first neighbor has $12,000 plus a little bit of interest. It's his. He can take it out any time. The second neighbor has paid $12,000 to the insurer. Then one day, he has an accident. He calls the insurer expecting the same level of access. I've paid all these years. Now it's my turn. But the insurer doesn't say, you've got $12,000 waiting for you. No. They say, we'll send out an adjuster. And from there begins the negotiation and your disappointment. You can see where the sense of betrayal comes from, right? People believe they've been saving for safety. What they've actually been doing is renting conditional help from someone whose profit depends on minimizing your payout. Let's talk about advertising and the emotional setup. Part of the confusion comes from the way that insurance companies brand themselves. They don't market insurance as a contract. They market it as comfort. Like a good neighbor, you're in good hands, peace of mind. These slogans aren't accidents. They're psychological engineering. They're designed to create an emotional connection, not a contractual one. And it works. You start to think of your insurance company as your friend. You call your agent by their first name. You wave as you go by their office. But here's the kicker. Once that claim is filed, you're no longer talking to the friendly face on the billboard. You're talking to a claims department. You're not talking with your neighbor anymore. You're talking with an adjuster whose job performance is measured by how little they pay out. So when they start saying things like, we don't pay for that, or that's not necessary, or we've already covered what we're required to, that's not personal. That's policy. It's a system built on incentives that reward minimizing claims. Now, let's be fair. Not every insurance company employee is bad or uncaring. Most of them are following the training and the metrics that are given to them. But the system is structured around one goal: protect the company's profitability. And you, the policyholder, you often find yourself wondering, wait a minute, aren't I the one who paid for this? That's when the light bulb starts to flicker. Maybe this isn't a bank after all. Let's take that metaphor, the bank idea, and stretch it out a little bit further, because it's eye-opening when you follow it all the way through. If you go to your bank and you ask to withdraw money, the teller isn't going to question whether you really need it. They don't tell you, we've decided you only get 40% because that's what we think is enough. But that's exactly what happens when you file an insurance claim. Let's say your car needs $10,000 worth of repairs according to the manufacturer's procedures. The insurer reviews your claim and says, we think that we can fix it for $7,200. You push back and they say, our preferred shop agrees. You take it to your own repairer, an independent collision center, and they say, actually, the $10,000 figure is correct and it's necessary. Now you're in a triangle. The insurer says one thing, the repairer says another, and you're stuck in the middle trying to decide who to believe. The bank never does that, but the insurer always does, because their model is built on evaluation, negotiation, and reduction. Here's a way to visualize it. Imagine if you went to the ATM, you punch in $500 and the screen says, we think you only need $350 today. You'd probably call the police, right? But when insurers do it, they call that the settlement process. And when you ask, why isn't this covered? The answer is always some variation of, it's not required, it's above the average, or industry standard says we don't need to do it. They speak in phrases that sound official, but are often arbitrary and unsupported by the manufacturer. And that's where your choice of repairer becomes crucial. At Nyland's Collision Center in Inglewood, Colorado, we don't base our repairs on what the insurer thinks is good enough. We base them on what the manufacturer says is required. Because when your car leaves our shop, it's not just about looking right, it's about being right. So what does this look like in real life? Let's take a few realistic scenarios and play that out across the country every single day. Scenario 1 is called the quick fix estimate. A driver is rear-ended. The insurance company sends out a mobile estimator who looks at the bumper, writes a quick estimate, and says, we'll cut you a check today. Sometimes they have you download an app, take some pictures, and the estimator doesn't even have to leave his office. Sounds great, right? Fast, convenient, efficient. But here's what's not being said. That estimate was done without removing a single panel, without checking for hidden damage, and without verifying sensor alignment or calibration. The insurer's goal? Close the case quickly and cheaply. Scenario number 2, we call that the preferred shop pressure. A policyholder calls their insurer and says, I need to get my car repaired. The insurer says, hey, you're welcome to choose any shop you want, but if you use one of our preferred partners, we can guarantee the repairs and get you in faster. Translation? We'll make it easier if you go to a shop that's agreed to our terms, not necessarily the manufacturer's. The third scenario is called, we don't pay for that. It goes like this. A repairer performs a proper scan and calibration as required by the vehicle manufacturer. The insurer denies payment, saying, we don't pay for that. But here's the key. They're not saying it's unnecessary. They're saying they're not going to pay for it. Those are two entirely different statements. If the manufacturer says it's required, it is not optional. But the insurer's wording makes it sound negotiable. And finally, scenario 4, the "it looks fine" trap. A car is repaired with imitation parts and paint that's close enough. To the naked eye, it looks fine. But months later, sensors start to fail and corrosion starts to show up because of improper fitment and materials. At that point, it's long after the claim is closed, and the insurer says, that's between you and the shop. All of these situations have one thing in common. They're the product of an insurer acting like a banker managing their money, not like a fiduciary stewarding yours. So what can you actually do about all of this? You can't rewrite the system, but you can protect yourself in it. Number 1, understand what you're buying. When you renew your policy, take 10 minutes to actually read it. Look for words like OEM parts, that stands for Original Equipment Manufacturer Parts, and like, kind, and quality, which is exactly the opposite of that. Look for words like shop of your choice and limit of liability. These are all important terms that come to bear with what you're going to get if ever you need your good neighbor. If you see vague terms, ask your agent to explain them in writing. Don't settle for a phone call summary. Get it documented. Number 2, consider adding an OEM parts endorsement. Many insurers offer this as an optional rider, sometimes called original equipment parts coverage. It ensures that when your car is repaired, the parts used must come from the original manufacturer. It's a small additional cost, but it can make a massive difference when something happens. Number 3, choose your own shop. You always have that right, no matter what you're told. In Colorado and in most states, the law says you can choose the repairer that you trust. Don't be pressured by your insurance company and their preferred lists. Ask the shop, are you following manufacturer repair procedures? If the answer isn't a confident yes, that is not your shop. Number 4, demand documentation. Every denial, every reduction, every refusal, get it in writing. Ask for the policy language that supports their decision. You might discover that most of the time, that language doesn't actually exist. Number 5, insist on pre- and post-repair scans. Today's vehicles are rolling computers. A fender bender can affect dozens of systems. Skipping scans and calibrations isn't just negligence, it's dangerous. If your insurer says we don't pay for scans, remind them that the manufacturer requires them for warranty and for safety compliance. Number 6, document everything. Document everything. Keep photos, invoices, emails, and text messages. Create a paper trail, because if you ever need to escalate a claim, your documentation is your defense. Number 7, don't sign off too quickly. Before you sign that final release, go ahead, have the vehicle inspected by somebody you trust. Once you sign, it's harder to get unresolved issues addressed. And finally, number 8, advocate, or find someone who will. If you're not comfortable pushing back, bring your vehicle to a shop that will. Here at Nylands, that's part of what we do every single day. We handle the documentation, the calibration data, the manufacturer procedures, so you're not standing alone against $1 billion corporation. Listen, here's what I want you to walk away with. Your insurance company is not your bank. They don't hold your money, they hold your contract. And that contract is written to protect them. When you make your premium payments, you're not making deposits, you're making wagers. And the only way to win is to understand the rules before you play. So educate yourself. Ask questions. Don't be afraid of industry standard. The industry's standard and your vehicle's safety are not the same thing. And if you're ever in an accident, don't let the insurer's convenience dictate your safety. Find a repairer who's willing to stand with you. Someone who repairs to manufacturer standards, not insurance allowances. Because at the end of the day, your vehicle isn't just a machine. It's more than transportation. It's freedom for you and the people that you love. And it's safety, or it should be, for those who are driving around you. And that's worth fighting for. My name is Reamer, and this has been another episode of the Airing of Grievances. I want to say thank you for tuning in. Rob will be back with us again next week. We're all so grateful for you. And I want to say happy Saturday. And remember this, if you will, please. Your story and your safety matter.